Yo, what's going on, everybody? It's Thursday. Today's Thursday. I made a video yesterday. I said it was Thursday. Today is Thursday, all right? Thursday, August 18th. So, markets closed up. Quiet day. And we were down most of the day, but it rallied near the end. Little bit, not a big move. So yesterday was a good fiscal day. We had a 36 billion leading flow, spending flow. We had a net of 20 billion. Yesterday, of course, we had the Social Security payment, so that helped. The deficit for August is already up to 189 billion. So we have surpassed July. July was 176 billion. We're at 189 billion. It's filling up the swimming pool, folks. Filling up the swimming pool. That's good. By the way, I saw a lot of commentary today, like the media already jumping all over the market stall. You know, I've said that we can see a little softness in here as we lead up to the September tax payment, but now I'm starting to think, we can keep going all the way up until that tax payment, because number one, I just see sentiment still really negative. I mean, every headline I saw today pretty much was about the stall in the summer rally. Oh no, market is struggling to keep the rally going. So like, you could see the sentiment right there. And today's I checked the AAII weekly sentiment survey, and still, bullish sentiment is still down. It went up a teeny tiny bit in the latest week, but it's still about 20% below its historical average. Bearish sentiment went up. That's interesting. That bearish sentiment on the part of individual investors went up in the latest week when the market, had this big move up. So, and that's like 20 something percent above the historical average bearish. So the bull bear spread, when you take those two, you subtract them, that's still negative. That's been negative now for 20 weeks in a row, and it's been negative for 37 of the last 39 weeks. So, I don't know. I look at that, and that just says to me, at the very least, I want to see that bull-bear spread go positive, at least for 1 week, if not more. I mean, we've been 20 weeks in a row negative. We've been almost 40 weeks, two out of 40 negative. I mean, I'd like to see that bull-bear spread go positive. I'd like to at least see, bullish sentiment at least hit the historical average, if not surpass it by a little bit. I mean, it's just very, very negative. Hardly any quantitative tightening. I looked again at the Fed. The Fed, we saw I think it was like a 29 billion drop in the Fed's balance sheet this week. And you might say, oh, that's good, 29 billion in a week. So it's down 60 billion since, don't forget, it's like 9 trillion, okay? So, I mean, we're talking, it's 8.9 trillion. We're talking peanuts here. So it's down 60 billion since the end of May. It's supposed to be down, based on what the Fed told us, what the schedule of QT was going to be. It's supposed to be down like at least 142, 143 billion. At least. And it's down like 60 billion. And half of that came last week, this past week, when it dropped 29 billion. And that's what the Fed added 10 billion in MBS, in mortgage-backed securities. Like, what's it doing? It's supposed to be what? They were on schedule to do 47.5 billion a month, right? With what was it? 30 billion of treasuries and 17.5 billion of MBS, and they added 10 billion of MBS. So I don't know what they're doing. I really don't know what they're doing. So QT still has yet to happen. Yeah, so I mean, I just think it still looks to me like I don't see any enthusiasm. I don't see any kind of, hyped up bullishness or euphoria about the rally. All I see is like, this is a rally in a bear market. The summer rally is struggling to stay alive. All this kind of stuff. Individual investors are bearish. They've increased their bearishness over the last week when, the market came up. Maybe that was because of the Trump, the FBI thing. I don't know. So fiscal is still good, 189 billion. Yesterday, strong day. We're already up to, I think we're close to 400 billion for the month of August in leading spending flows. I said we're going to have probably a 550 billion month. Of course, we had the quarterly interest payment. If you don't see by now how these things, the things I've been, the things I focus on, the things I educate you on with respect to these flows, these fiscal flows are everything, folks. They're everything. And the great news is that the people have it wrong. They've got it completely wrong, particularly with, number one, the tunnel vision focus on monetary policy. Number two, their understanding of monetary policy was completely wrong anyway. And so now they're really pounding the table for higher interest rates. And that's, over the cycle, over a period of time, that's just going to keep adding to fiscal, keep adding to fiscal, keep adding to fiscal. We're already starting to see that happen, and this is just like the teeny tiny start of it. It's like in the last couple of videos, I've been using the hurricane analogy, the hurricane metaphor, right? Well, we could do this too with the interest rates. Like right now, there's a storm out there. I'm looking out the window right here at the Gulf of Mexico, right? Which, by the way, we've had a really, really quiet hurricane season. There hasn't been anything really. And given, the tremendous heat that we're having this summer, the water out here, I went in the water and I'm going to go a little bit later. It's like a hot bath. That's energy, man, just stored up. Anyway, using this, using the hurricane analogy, I just saw a dolphin swimming. So we know it's coming. It's out there. The satellite has the picture. That's September 15th. But that's not, that's not a Category 5 hurricane or anything. April was, I wouldn't even say that was a Category 5. That was like a Category 3. September is going to be like a Category 1, 2. But we know it. We see it on the satellite. We see the radar. But right now we're starting to feel, maybe little tiny raindrops, just a little, nothing, little sprinkles, no wind really, little sprinkles maybe starting to come in. It'll come in later. So yeah. So I think I think the sentiment is still negative. I think we see that in all the commentary. I saw one article on, what's his name? They call him Dr. Doom, the economist. And by the way, that was a name that was given to Henry Kaufman back in the 1970s, Dr. Doom. He was a chief economist at Salomon Brothers. Oh, Nouriel Roubini. I don't think this guy's ever been right about anything, but he's really pounding the table, saying the Fed's really they got to double the interest rate right now. They got to double the interest rate. This is a very schooled individual. He's a professor at NYU, right here in New York City. Well, I'm not in New York right now, but he's a professor at NYU. He's an economics professor. He's like, they got to double the interest rate. Not understanding, apparently, that the government is a net payer of interest. You double the interest rate, you're jacking up the fiscal transfers in a major way. I think I told you guys this, but back in when Ronald Reagan was elected, And he was elected on a platform of we're gonna beef up the military. We're gonna, because Carter, and then there was a whole debacle with Carter and spending cuts in the military, and that attempted rescue of the hostages in Iran, which was a disaster. And Reagan came in, rah rah America, and very jingoistic on the militarism and stuff like that. And we're gonna beef up that. And he was famous for. I bet if you ask most people, like, what was famous, what was Reagan famous for in terms of economics? Well, they're going to say number one, supply side, right, which is cut taxes for the rich, and cut everybody else's wages, destroy the unions, and then the rich are just going to send down their little crumbs on the rest of us, and that's supposed to really boost the economy. So tax cuts, and then they're going to say defense spending, right? But the fact of the matter is, and I've gone back and I looked at these numbers, and you can look at them. You don't have to take my word for it. If you go to BEA.gov, the Bureau of Economic Analysis, there's a free online, the U.S. government has so much data available, like the daily Treasury statement that I tell you about every day. You can go back and look at the flows, back in Reagan in 1981, 1982. The biggest flow, fiscal flow, was from interest payments. Rates were like 20%. Volcker jacked them up to 20%. And it was a massive, massive fiscal transfer. I remember my grandmother back then. She passed on, but I mean, back then she was loving it. She had CDs at the bank and she was making 20% return without doing anything, free money. And here's a guy, he's teaching economics at NYU, a very prestigious school. It has become. It wasn't in my day, but I mean, it has become a very prestigious school, hard to get into, very expensive. And he's teaching economics and saying, they got to double the interest rate. They got to triple the interest rate. Dude, the government is a net payer of interest. You raise the rate, that's just like sending out checks. It's sending out checks. All right, you see what I'm talking about? So it's funny. I think it's funny. Anyway, that's it for today, folks. I'm heading back to New York tomorrow. I hope you had a great day, and try to do a video tomorrow when I get back. I don't know. But in any case, have a good one. Bye.